Right now, there is a 3-digit number that decides whether you can buy a house, lease a car, rent an apartment, or even get hired for a job. You did not choose this number. You did not vote for it. You were never asked if you agreed to be measured by it. Most people assume this system has been around for generations. They think it is an ancient and proven method of determining whether someone can be trusted with money. They are completely wrong. This number did not exist before 1989. It is younger than Taylor Swift. It is younger than the World Wide Web. It was created by a single private company, and its entire structure is designed not to protect you, but to ensure that you never stop borrowing money for the rest of your life. This is not a credit score. This is a compliance score. And once you understand how it actually works, you will never look at your financial life the same way again. Before 1989, getting a loan was a fundamentally different experience. You walked into a bank branch. You sat across a desk from a human being who knew your name, knew your employer, knew your neighborhood, and had likely watched you build your life over years or even decades. That banker made a judgment call. It was subjective, yes. It was sometimes unfair, absolutely. But it was a human decision made by a human being who could weigh context, character, and circumstance. If you had a rough year but a strong history, that banker could say yes. If you were a first-time borrower with no track record but solid employment and community ties, that banker could take a chance. The system was imperfect, deeply flawed in many ways, but it was rooted in the idea that a person was more than a number. Then 1989 arrived, and everything changed. A company called Fair Isaac Corporation had been working on an algorithm since the 1950s. Their goal was to remove the human element from lending decisions entirely. They wanted to replace judgment with data, replace intuition with calculation, replace the banker with a machine. In 1989, they launched the FICO score. 3 digits, 850 at the top, 300 at the bottom. And suddenly, for the first time in American history, your financial life was decided by software. The banks loved it immediately, and they had every reason to love it. An algorithm does not take lunch breaks. It does not get sick. It does not have bad days. It processes thousands of applications per hour. And most importantly, it made the lending decision invisible. When a human banker denies your loan, you can argue with them. You can present your case. You can ask why. When an algorithm denies you, the answer is a number. You cannot negotiate with a number. Fair Isaac built their scoring model around 5 core factors. Payment history carries the most weight, roughly 35% of your total score. Then comes the amount of debt you currently owe, which is 30%. After that comes the length of your credit history, which is 15%. New credit applications account for 10%, and the type of credit you carry is the final 10%. Now read those categories again. Every single one of them is designed to measure one thing: how deeply and how consistently you are engaged with the debt system. Payment history rewards people who have been paying debt for years, not people who are debt-free, people who have an ongoing relationship with creditors. The length of your credit history rewards people who have been borrowing for a long time, not people who built wealth without debt. The amount you currently owe rewards people who carry a balance within a certain range, but penalizes people who owe nothing at all. This is where the system reveals its true nature. Think about this scenario carefully. A person has $2 million in savings. They own their home outright. They have 0 credit card debt, 0 car payments, 0 loans of any kind. They have never missed a payment in their life because they have never needed to borrow. What is their credit score? It is either extremely low or completely unscoreable. The system literally cannot process a person who does not owe money. A debt-free person is, in the eyes of FICO, an invisible person. And an invisible person cannot rent an apartment, cannot get a mortgage, cannot pass a background check for certain jobs. Let that sink in for a moment. The system that is supposed to measure your financial responsibility actually punishes you for being financially independent. This is not a bug. This is the design. Pay off your credit card in full every single month. Good practice, right? Wrong. If you carry 0 balance for several consecutive months, your score drops. The algorithm interprets it as reduced engagement with the credit system. You are not rewarding the system with interest payments. You're not giving the machine a reason to track you. Pay off your car loan early. Financially smart, saves you thousands in interest. But the moment that loan closes, it becomes a closed account. Closed accounts eventually age out of your credit history. Your credit mix shrinks. Your score takes a hit. The system is structured so that the financially healthiest behavior, carrying no debt, is the behavior most harshly penalized. And this brings us to the core question that every person should be asking. Whose interests does the credit score actually serve? Not yours, not the consumer's. The credit score serves the lender. It does not measure how much money you have. It measures how much money you will make for the bank. A person who pays off debt quickly is a bad customer. A person who carries a revolving balance and makes minimum payments for years is a perfect customer. The scoring system rewards the second person and punishes the first. This is financial behavioral engineering. The system does not just reflect your creditworthiness, it actively shapes your financial behavior, it trains you to borrow, it rewards you for staying in debt, and it punishes you for getting out. Now let us draw the comparison that makes the Western world deeply uncomfortable. In 2014, the Chinese government began rolling out what it called the social credit system. The concept was straightforward. Assign every citizen a score based on their behavior. Buy too many video games, your score drops. Help a neighbor carry groceries, your score rises. A low score means you cannot buy a plane ticket, cannot rent luxury property, cannot access certain services. The Western media covered this extensively. The headlines were immediate and alarming. Digital tyranny, government surveillance, a system that controls your life based on a number assigned by the state. Now ask yourself this question. How is that fundamentally different from what FICO does? Your FICO score determines whether you can rent a home, whether you can buy a car, whether you can get a job, whether your insurance premiums go up or down. It is maintained by a private corporation, not the government. But the effect on your daily life is nearly identical. If your FICO score is below 580, landlords will reject you. Employers and financial sectors will screen you out. Insurance companies will charge you more. You're locked out of the basic infrastructure of the modern economy, not by law, by algorithm. The only meaningful difference between the Chinese social credit system and the American FICO system is who runs it. One is run by the state, the other is run by a private company. But in both cases, a single number decides the boundaries of your life. And here is what makes the American version arguably more insidious. At least with the Chinese system, the citizens know they are being scored and by whom. With FICO, most Americans have no idea when it was created, how it actually calculates their score, or why debt-free living is treated as a liability. The system works because it was introduced gradually. In 1989, FICO launched. Through the 1990s, credit cards became ubiquitous. By the 2000s, every major lender was using the FICO score as their primary decision tool. By 2010, it was embedded so deeply into the financial system that nobody questioned its existence. It simply was the way things worked. But it did not have to be this way. It was chosen. A private company created a scoring model that benefits lenders. Banks adopted it because it made their job easier and their profits more predictable. And over 36 years, it became the invisible architecture of financial life in America. Now let us talk about the debt cycle the system creates, because this is where the trap becomes permanent. The moment you turn 18 in America, you are encouraged to open a credit card, build your history, establish your score, get a car loan, get a student loan. Every single financial institution you encounter from that age forward is telling you the same thing. You need debt to prove you deserve more debt. This is not financial education. This is recruitment. The system needs you to start borrowing young so that by the time you reach your 30s, you have a long credit history, a healthy credit mix, and a score that qualifies you for a mortgage. And a mortgage is where the real extraction begins. A 30-year mortgage on a $300,000 home at 6% interest means you will pay roughly $540,000 over the life of the loan. You're paying 140% of the original price. The bank does not just get their money back. They nearly double it. And your credit score is the gatekeeper that ensured you would enter this arrangement. If you try to pay the mortgage off early, your score will eventually suffer as the account closes. If you try to avoid debt altogether, you cannot get the mortgage in the first place. The system forms a closed loop. Debt leads to credit history. Credit history leads to more debt. And the cycle continues for the entirety of your financial life. This is what behavioral economists call a debt treadmill. You're running constantly, you're making payments every month, but the finish line never gets closer because the system is designed so that the moment you cross one finish line, a new race begins. And the people who designed this race knew exactly what they were doing. Fair Isaac did not stumble into a scoring model that happens to reward borrowing. They engineered it. They studied consumer behavior for decades before launching FICO. They understood that the most profitable customer is not the one who borrows once and pays it back. The most profitable customer is the one who borrows forever. So the score they built reflects that understanding. It is not a measure of your financial health. It is a measure of your value to the lending industry. Now, I want to be clear about something. This video is not telling you to destroy your credit score. It is not telling you to refuse to play the game. In the current system, a good credit score is a tool. It opens doors. It saves money on interest rates. It provides leverage in a world where this number matters. But there's a critical difference between using a tool and believing in it, between playing a game and thinking the game is fair. You should know how to keep your score high. Use your credit cards, pay them off every month, keep your utilization below 30%, and let your oldest accounts stay open. These are the mechanical moves that keep the machine happy. But you should also be building something the machine cannot touch. Cash reserves that do not depend on credit. Real estate owned outright. income streams that have nothing to do with your FICO number, skills, knowledge, and assets that exist completely outside the scoring system. Because here is the truth that the system does not want you to reach. Real financial freedom is not a high credit score. Real financial freedom is the ability to walk away from the system entirely, to buy what you need with money you already have, to live without a single creditor having any claim on your future earnings. That is called leverage, and it is the exact opposite of what the credit score system is designed to produce. The system wants you dependent. It wants you measured. It wants you training your children to open their first credit card at 18 because that is what you did and your parents did, and the cycle continues without anyone ever asking whether it should. But the moment you understand that a 3-digit number invented by a private company in 1989 is not a reflection of your worth, but a measurement of your usefulness to an industry, the entire frame shifts. You are not a credit score. You have never been a credit score. You were told to become one. And the first step toward financial freedom is understanding the difference. The system is still running. The algorithm is still scoring. But now you know what it is actually measuring. And that knowledge, that alone is worth more than an 850. Here's what I want you to do right now. Go down to the comments section. And if this video changed even one thing about how you think about your credit score, write this. I am not a number. Let me know if you want to hear the next part of this series. Because the story of how credit bureaus sell your personal data to corporations while you pay them to monitor your own information is a conversation we need to have.